So we just crossed 4% portfolio yield. And yes, I had to do a little bit of rebalancing to get there, which I will explain in this video. Trimmed some positions and I've added 2 ETFs to the play. And basically the income jump was immediate. A lot of these came from comments from previous videos and I was a bit dismissive of having an ETF, but it is logical. So today I'm going to explain what changed, what I've removed, what I've added, and why this will make the journey a lot easier. May well be a little bit less appreciation growth, but the income is certainly welcomed. So a quick refresher if you are new around here, £1 million by the time I'm 50 years old. We're well on track, by the way. And the aim is to put it in a tax wrapper, a stocks and shares ISA. Yes, I do have a SIP and all that kind of stuff, but this is just tax-free, capital gains free, put 20 grand in every single year and see what we can do. Dependable kind of yield, more importantly, a little bit of a dividend growth in there, and to avoid the yield trap. So it is quite a good, solid portfolio. And I know I've been chopping and changing. It is going to be quite a dependable portfolio over time, right? So that's the plan. I am pretty happy with it now. So overall, the portfolio, as you can see, total return on the entire portfolio since I started, 6,500. In terms of the pie, 2,500, because the pie is obviously came in later. But let's talk about what I trimmed off. So I did a bit of a cut and run. I bought into the global dividend aristocrats, which is basically dividend funds. The portfolio, the dividends and the yield is paid out over a period of 10 years or more. Right. Problem I had with this, and I will explain in more detail, the chart performance wasn't great, but more importantly, there was a lot of American stocks in here, and I wanted to predominantly UK. My personal opinion, by the way, don't come at me in the comments, just a thing. But what I didn't like wasn't so much the performance over the course of time, which is better elsewhere. It's the fact that the dividend yield was actually relatively low versus what I expected. I did research on another platform. I didn't really use just ETF at the time, and I should have looked at that more closely, and I didn't. It has come down quite aggressively, and I don't like that. So that is one of the obvious ones of why I've changed it. So yes, I have trimmed it. Well, I've basically removed it. I've went in, got the ex-dividend there, and I'm going to get the dividend, and I'm basically pissed off, which is fine. So the situations around that, which is hugely, hugely important. So yes, there was issues here, and you're going to see exactly why I've changed my portfolio, because it has made a massive change. Now, other things that I have changed is I have changed the weight of the portfolio, which I will explain in more detail. I don't want to reveal it just yet. But the lower dividend payout ones I've reduced. I've made that long-term for the growth, so they will grow over time. And I've made it so you got ETFs to decent weight. You've got the middle cap element of like balance in the middle, and then the low yield payers at the bottom. And it has made that dividend yield go up to 4%. Now, the other thing that I have added, I've added 2 things. I have added the iShares UK Dividend Fund. Ticker is IUKD. If you've been watching my YouTube videos on this, and if you've been subscribed, you'll know. I looked at this, I recommended it to you guys and went, oh, I should have that myself. And I now have. So it is a reliable ETF with solid performance. It has a mainly United Kingdom investment focus. As you can see, 93%, and it is pretty bloody solid, right? Overall, you can see the metrics. If you go back to the previous one, that is a much stronger performance growth. The dividends are a lot more stable. As you can see, current dividend yield is 5.21. Even though it was more last year, that obviously fluctuates a little bit, but it's nowhere near as deep in terms of correction. That is a big, juicy one, realistically, right? And again, we can look at the volatility index. It's okay. It's not as crazy as the last one, so to speak. It's not probably about the same, but realistically, over the course of time, you are looking at some decent dividend yields here. So, yeah, it ticks all the boxes realistically in terms of the amount of dividends you get, the companies that they have, and more importantly, the fact that the fund is relatively popular and it's been around for quite a decent chunk of time now, since the 4th of November 2005. And the last one that I've obviously added was the Vanguard FTSE 100, basically the VUKE. So it's a really good FTSE 100 index which tracks the top 100 stocks, and most of these are dividend payers, so it makes obvious sense. And again, performance has been pretty damn blooming solid. As you can see, most of it is United Kingdom. There's a performance overall, as you can see, relatively strong. The dividends, relatively strong again, decent amount, more than the previous one. So it kind of made sense having both of these. but the volatility index, not too bad at all. So it is a pretty solid one, and it just fits the thesis completely. So let's look at the overall portfolio. If you've been watching my previous video and the first video I did on the series, we were about 2.5%. Now we're at 4, actually 4% yield on cost now. So it has made a massive, massive difference, and it will increase the compound effect faster. And I will go through the weights in a bit. But the overall element of this is faster, efficient yield with the payouts being more aggressive, but more importantly, the actual stocks themselves don't just depreciate. So you'd probably argue pretty stable. And even with the likes of the dividends here, you'll see this pretty quickly. It's a lot more stable. And the ones down at this end, I've got less weight in. The ones in the middle got pretty average. And then most of the weight is actually in the ETFs, which will make more sense. And as you'll see, it'll make more sense. But overall, as you can imagine, this is a much neater number. It's a lot heavier. And it will, as I say, allow the distribution of that wealth to be kind of, accumulated faster, which kind of makes sense. And going on to the calendar here and going on in terms of what could be happening, the yield's pretty nice here in terms of the 1 year ahead. There's going to be some pretty decent payout months as well, and it's quite distributed over the course of the year, which is pretty important. So I'm pretty damn happy with this. And if you're interested in this platform, there's a link below. You can get 10% off. It's a really good platform. It's always good to be ahead of the curve in terms of what you're doing. But yeah, in terms of this, you want to get the big, juicy, fattest checks and to get the cash reinvest into that pie and to allow that snowball to grow. And because realistically, what is happening here is just allowing the speed of this investment to go. Even though it's 11.77% returns on average over the course of these stocks, we're still going to be hitting some lofty targets in and around a portfolio element of 2040, which isn't that far away and actually hits the ballpark figure for when I am 30. I'll be 49 when that actually happens. I have to do some quick math. So it has increased the speed. But also, even though this is hitting 1 million, I know this is unrealistic, obviously, but you can see how the overall growth of the dividends and the dividend yield here is going to be pretty impressive by the time we hit year 10, which you could be arguing we could be looking at £24,000 per year if it all stays the same or gets even bigger. Now, in terms of the overall portfolio, let's go through it. So you can see 20% in the 2 ETFs, that's 40%, and then 60% of it's individual stocks. I have a trust fund in here. I have all the bigger ones hitting the 5% mark, then going into the 4s, then going into the 2s and the 3s, essentially. And that just, in my viewpoint, just makes obvious sense. Now, in terms of the overall annual growth rate of it over the course of the average, 12.79%. So it's actually, they're still distributing some gains there and actually quite normal in terms of stock market standards, plus the yield at 4%. So I think I've got it pretty much nailed on. The time now is to basically just keep investing and investing and investing. There's a couple of things I am looking at in terms of individual stocks to maybe add to it, but not yet. I'm just going to wait. And I think for me, overall, I want to keep it simple. And I think that this could be a pretty solid overall growth portfolio. It just needs capital now. Now, I know in terms of like Q&A and comments and stuff, I've had a lot of questions by why not buy a high yield ETF and just chill. And as much as I like that idea, and I have already obviously done that, I want it to be an explanation to a lot of people that you can do individual stocks too, which could obviously outperform ETFs in terms of overall yield on cost and stuff like that. So there's an element of quality of 40% ETFs and a blanket of overall individualism, which could do very, very well, which could allow even faster growth. But also, again, I know I'm going to get a question, why just UK stocks? Well, even though this fund alone in the ISA side of it is tax-free, there's no such thing in terms of that with an American stock. You still have, if you're investing, you still got to pay stamp duty, but you've also, if it's an American stock, you pay withholding tax on the gain. If I'm holding something for quite a while, there's a problem because you're going to pay the tax on every single dividend. That's the point of this portfolio. So with withholding tax, you don't pay it on the capital appreciation. So yes, if I'm doing an American stock, it will be zero dividends, basically like a Bitcoin miner, for example, or other bits and pieces like that, where it's tech heavy maybe, and there may not be any dividends. Whereas with this, the gain over the dividends, which in my viewpoint is obviously a gain, you get paid by the company, you're going to lose 15%. If you're investing, say, Apple, which is like 0.74% yield or whatever daft, it's probably pointless, let's be fair. So yeah, the plan now is just to keep an eye on what is the upcoming events for the entire portfolio. Keep an eye on it. Keep people updated. Dividend announcements. The Bank of England rate path, so to speak, and even the UK CPI prints, which could affect this market pretty aggressively. The FTSE 100 is currently at all-time highs, which is good to see. So things are looking a bit better, I suppose, and it makes more sense. So we just need to keep an eye on it. Most of the information and actual news in terms of my portfolio is actually relatively strong so far. So we need to keep an eye on it. But ultimately, you can see overall in this picture, a lot of things are looking a lot more aggressive for growth. As I say, it just needs capital, and we're going to feed it the capital. There we go. The next video you'll see from this as an update will probably be an investment and see how the performance overall is doing in terms of the technical analysis as well. But yeah, if you like this sort of stuff, leave a like and watch this video here, which might help you gauge what ETF you should be looking at if you are thinking about buying ETFs. I do cover the dividend ones on there.